release or the report was just released around 30 minutes ago. Better than expected. But the market reaction initially, when looking at equities especially, we saw a quick pop higher, but then we sell off again now. And I think what this perfectly shows is that the employment report itself is not really of that much interest, let's say, in the current market environment, but it's the overall BS which market participants focus on. And this is something we want to cover today. So what we can make out of this report, what it means, not just for the overall US economy, but probably also and especially giving the overall situation we face with the Fed and we face in terms of yields, especially, and further rate hikes, what to expect here. The market itself, let me put it simply and straight away, I was really surprised of yesterday's price action and the sell-off we've seen there after the initial bullish reaction. What's certainly interesting is that we just reversed all the bullishness from Wednesday evening, so in German time, Wednesday evening, and we completely reversed the move post the Fed. But still, we somehow, underlie some kind of, let's say, cognitive BS probably here, which is letting us feel that this was heavier on the downside and more fear giving, let's say, then we felt some kind of, let's call it, joy once we ran higher. This is a phenomenon which we usually refer to as loss aversion. And this is also something we probably want to have a look at. We have some clear levels to watch, especially in terms of the S&P 500 after yesterday, also today. After the news release here, I will share my thoughts here on the overall market, but we also certainly want to have a look here at EURUSD, at gold, for example. Probably not necessarily EURUSD, but more GBP/USD after yesterday's rate decision. And so let's start with today's webinar. We have a slightly a different presentation now because we will go through the markets, and going through the markets in this context makes it necessary that we first of all here start with the risk disclaimer. Please read it carefully. If there's any trading setup we formulate or anything where you say, well, this sounds bullish, what Jens is saying here, or that sounds bearish for this and that asset, please understand that if you take a trade based on this information, you take it on your own risk. So everything I present here is for information and educational purposes only. So very, very important. So please read the risk disclaimer carefully. If you want to read it in full, because right now you're not fast enough to go through it, then please check out the website admiralmarkets.com for further informations here. By the way, Admiral Markets, this is the broker who's standing behind this webinar series in general, Trading Spotlight, but also behind the webinar today on the non-farm payrolls. Broker already in the industry now for 20 years plus. Offices around the globe, fully regulated by several regulatory bodies overseeing the overall business from admirals around the globe. So may it be in the European Union with the CISEC, may it be in the UK with the FCA, may it be in Australia with the ASIC. Most recently, there was another regulatory body included overseeing the business now in Jordan. What this means for your trading also, you can find all details on the website. If not, and if you have further questions beyond what you find on the website, please feel free to reach out to Admirals directly. So one world, one broker. That's that's in fact the slogan here. Very important. Also, I just realized since we are working with the MetaTrader here now, and I don't have a risk disclaimer on my screen. I decided to take a German one, which will read here exactly as the one you can see it here. By the way, let me just take it out. So you can see here. So it's German, but it's the translation into English would be: trade responsibly. 81% of retail investor accounts lose money when trading CFDs with this provider. You should consider whether you can afford to take the high risk of losing your money. So this is the risk disclaimer you will see now in German here when I switch over to the MetaTrader. So there's the risk disclaimer. So you can see here, this is the 81%. So the numbers are one or identical in this context, just for your information. If you check out the bottom now, I'm just seeing some weird language there. So this is German, and the translation, I just read it from the presentation before. Let me just check the chat box first if all questions arrive, but this looks perfect. So if you have any questions, please feel free to use the chat box here. So hello traders, if you have any questions also on markets we should have a look at, please feel free to enter them right here in the chat box so that I can go through them. As I already said, I will cover plenty of markets, but probably you say, well, I'd really like to get some thoughts on XYZ. So just let me know and we will check out the charts then. And that's it around the introduction. So just have a look here at the current situation. I have EURUSD here. I have the DAX here. I think all this doesn't make really sense to look now at the charts. First of all, I think we should check out the non-farm payrolls and the numbers which were released here. Some of you probably follow me on Twitter. I'm not sure. If not, you can find me under @Jens Klatt FX in this context. And here, as you can see, that was 5 minutes after non-farm payrolls were released. I just covered it there and yeah, posted it here on Twitter so that we now have also all informations within the webinar. So what happened was payrolls were published here, were released at 4:28. And we're estimated at 380. So this is probably something where you say, okay, better than expected. Yes, and now but. And why but? This is something we will dig deeper into in the following minutes. Private payrolls 406, estimate was 390, also better than expected. So the first thing, which is like a little thorn in the side, let's say, is the unemployment rate here, 3.6 against 3.5%. Still very good, I think we can call this. Average hourly earnings below expectation. This is especially disappointing, let's say, in the current environment in regards to the inflationary pressure, which is building here. That average hourly earnings month on month here in this context came in below expectations, 0.3 against 0.4. And earnings, if you look at them, average hourly earnings, if you look at them on an hour, on a year-to-year basis, compared to 1 year ago at the same time. So we are higher 5.5% here against the estimate 5.5%. So if you want to sum this up, I'd say, well, if I had to sum this up now, I'd say it's a mixed report. It's nothing outstandingly good. It's nothing outstandingly bad. It's just very close to what could have been expected. And I think this is the problem right now, because this is showing why the initial reaction. Let's come back here to the DAX, for example, and this is an hourly chart. Let's have a look here at the 5-minute chart, for example. So you can see we come in slightly bullish into the event, popping higher. So this is the candle here. Let me just probably zoom in a little. So this is the candle where we pop higher, and then after 5-10 minutes later, we're now selling off and now giving back all the gains which the DAX had seen coming into the event. So we came already in quite bearish after yesterday, especially. So let me just zoom out once again. So yesterday was okay. That was like the opening was like a retest of a breakout region. That's probably the best way to put it. In case of the DAX. So you can see here that was the bullish spike, the bullishness we got to see after the Fed in this case, and I'm very positive when we saw this push higher here, and especially after we broke above the pre-weekly highs. That was the first positive sign. Then we rolled over. We saw a retest in the morning that was around 14,150, 170, this region. I was like, well, we could probably think about going long against this region. Therefore, still, I wanted to see something which I tend to say when looking at the DAX. And you can see the moving average already here. So this is the exponential moving average 50 on a 5-minute time frame, and it's my, let's call it, advantage identifier. So simply speaking, I say as long as we trade above, I'm looking for long engagements. As long as we trade below, I'm more BS to the short side. So very roughly speaking, but it gives me, without having any lines in the chart, a clear overview by just looking at the chart. So which side I should favor, and then I go one time frame higher, and I look, okay, where we trade, and then take it from there. So when we came in yesterday, now I'm retesting here the region around 14,150 around from the evening before. I wasn't overly bullish for the day itself, since we came in and traded below the EMA 50. But I said, well, if we can now make it back above the EMA 50 and hold above, then I'm willing to take the long side. And I was watching the price action carefully here. That was around midday German time, and we're coming in here and tried to recapture the exponential moving average, falling together with 14,200, and then we rolled over. And when we had new intraday lows, especially then also with the pressure which we got to see from US equity markets, we gave back not just all the gains, but also close below that level here. And I was already saying, well, if we can hold the breakout region, that was kind of a, like, in German, I called this Windbeutel. And like, let me just see what's the English word for this. Windbeutel, probably there is no such thing. Translation, let's me just see. English translation, translate, yes, please. It's a cream puff. You know what this is? Like, yeah. Okay, so it's a move without a real, like, it looks really big, like, okay, and it's just air in it. So like there's no sustainability in it. It's really, it's delicious. So to have it like in the afternoon with your family, especially the kids love it. But there's no, like, there's nothing behind this. Let's put it that way. And that was how I called this. So the move here, if we drop below that level, 150 in this case, then we it's not that we're in trouble, but still the move from the day before looked a little like a fake out, probably. That's also a way to put it. So we dropped. The interesting thing there was when we closed yesterday, it was around here in this area where we're closing below the lows from the day before. So this is already quite ugly from a technical perspective, but still it's like, okay, well, we just gave back the gains from the day before, and all in all, when looking at what the Fed delivered, it's nothing we should consider overly bullish, let's say. The rate hike itself was already expected, but they also communicated that they're planning to reduce the balance sheet. And reduction of the balance sheet, we probably remember last time they did this. That was in the fourth quarter of 2018. Just have a look at the chart back then, and you will see that the market were very volatile. Back then, I was kind of like a little annoyed, let's put it that way. So a little peeved, probably, since Christmas was the most volatile Christmas in equity markets, even though there was a shortened trading period in the S&P, that I still had to somehow watch it and wasn't really that focused on the family. I really tried to avoid watching at the chart or at the app and what's happening there, but it's very difficult if you're in the markets and you're really you in the markets, then you just can't look somewhere else. So that's definitely something I had to work on. But remembering back what happened back then. So that wasn't overly bullish. So you usually don't expect this reaction, even though you probably expected once it was fully priced in. So then we are dropping here, and it's not just that we just can make it back above here. It's around 13,800, probably 14,000 points. But now we are selling off even further, and that's the overall BS. It's like we are looking at the DAX here, but we can see the same in the S&P, for example. And then if the non-farm payrolls, which were released today, don't really stand out on one or the other side, but just came in very close to what was expected, then expect overall the BS to continue. We already saw, which is on the downside. So like market participants are already bearish. When I say what did market participants expect, let's probably dig a little deeper into how I prepared for the non-farm payrolls today, and why I'm capable of saying, well, the numbers came in as expected. So therefore, let's come back here to my Twitter account, and in the morning I retweeted this guy here, Anthony Barton. By the way, if you're on Twitter, I highly recommend following this guy, respectively writing down the name. If you don't plan to follow him, write down the name, because every first Friday of the month when non-farm payrolls are released, you get a very detailed quote from his end here on the NFP guesses from the primary dealers. So long thing short, or very roughly speaking, he in fact writes down which investment banker or investment bank / analyst of this investment bank expects the NFPs to come in at what number. So it's not that we for example here look at the economic calendar and then you have like a forecast 391 and this is the number everyone is expecting. But what these what these numbers say is, well, we have like it's an average number. So one investment bank analyst expects numbers to come in at, let's say, 500. The other one expects it to come in at 300. We have two guys. And then the average is 400,000. So simply speaking, and this is exactly why I look at these numbers here, because they give a better idea of in which direction are we skewed here. So are we expecting a significant number above 400,000, or is it more like below 400,000? And that being said, then brings me to this chart here. And as you can see, so it's nothing really spectacular, but something you can work with, especially if you plan to prepare for the non-farm payrolls and for today. And what I did in the morning, one second, please. Excuse me. So what I did in the morning, so that looks really like I'm painting of a 3-year-old here in this case. But what I did, in fact, is like I have this distribution, let's call it, this curve here. So very similar to a normal distribution curve. And as you can see here, I have these two vertical lines I put in. And why do I put these vertical lines at 380 and 420? Well, I do it because you can see here, so 500,000. So then we come in, so around 400. So this is what market participants obviously expect, and you can already see it here. It's the median. It's 400,000 around. Probably here 420 probably. That's a better way. And then you have here 360, 380 around this, and going down to 300. So, and you can see that the numbers here are very, very close to the numbers here above 420. So numbers means numbers of market participants expecting, or analysts expecting, above 420 and below 380. So that being said, delivers then an estimate that I can say, okay, if the market, if what the overall market is expecting, you can find this in the economic calendar. So saying 391. This is just one number. And now we could say, well, everything above 391 is positive, everything below is negative. But what I do, I go in more depth here and I say, well, given what I see from the primary dealers, I can say 380 is the lower bound and 420 is the higher bound, and saying everything in between there is somehow expected. So that means I really need to see a number out of this let's call it box, or these two lines here, and then you can see here that 500,000, 300,000, these are the highest estimates on the upside, respectively on the downside. And now the numbers came in here, like there. So and not here. So I'm sorry, this looks a little weird, but this is what I wrote here when I explained this to a client in the morning. I was saying, well, that was exactly the question he asked. So like, okay, what will you need to see? And I said, well, everything above 500,000, respectively, significantly below 300,000. That's a surprise. That's what no one is expecting. And why is this of importance? Because if no one is expecting it, then you see moves in the market. Everything else is like, you could put this in quotation marks, but it's like market participants are hedged. That's what they are expecting. So their portfolio, their positioning is somewhere in this range. Even though everything significantly above 420, still below 500, is somehow expected, not really expected. Probably you see some kind of a move. The same is true on the downside. But numbers now come in here at 428, and this is slightly above what the market was already expecting. So slight push out of this range, but still it's like right next to the range. So no big surprise here with the numbers at all. And that being said, now coming back here to the NFP print. So you have a print here, which is like what market expected. And then you see an unemployment rate, which is slightly higher than expected, not very positive. You see hourly earnings like 0.3, again, 0.4 expected, on a yearly basis, 0.5, 5.5, like it's nothing spectacular. So it's no really big event happening. And this is exactly why I say, well, that's no surprise then that you don't see big reaction, let's say, or let's say we probably anticipated somehow better than expected news release. Why do I say better? Well, because now we have to look at the overall picture. So where do we stand? So we have a Fed which is coming out very hawkish. Well, we're at least very hawkish in terms of where we stood, let's say 1 year ago. But market participants are already expecting this hawkishness, so that the Fed will continue to hike rates, which is very interesting. Now, well, what we now can say is, okay, let's have a look here at where's the Fed watch tool standing. This is a tool which is completely free of use, by the way. So you can just Google Fed watch tool, or you can check out here the link. Let me just write this down, Fed watch tool. And what you can do with this tool is you can see, okay, what is the market expecting? So what they do is they derive, let's say, from the options market. So you have probably heard about Chicago Mercantile Exchange. So this is a stock exchange where you can trade futures, options, and it's a quite big exchange. So, but where lots of turnover is generated every day, lots of volume is traded, and they have now mathematical models, roughly speaking, which derive based on, for example, option prices, what market participants are expecting in terms of yields, and for certain durations here. And based on that, they now have this tool where you can see, okay, right now, given what the market is pricing in and what options showing us, let's say when looking at T-note future, S&P 500, NASDAQ, and so on and so forth, and especially here the options market, what you can see is that market participants are, for example, expecting the Fed to hike another 75 basis point at her June meeting, which is on the 15th of June, by 96%. Great. So that's the first information, which is very interesting. So everything which is pricing this out now, so like we only see a 50 basis point hike as we've seen last Wednesday. Probably this is less hawkish than what the market is expecting and more bullish for equities. So you can now go here till February next year. So 1 year from now, you can see, okay, well, then beyond that, you can see 50 basis points in June, in July. You can see another 50 basis points by around, let's say, something like 50% or so, 90%. Yeah, and so on and so forth, and can really see what the market is expecting. We don't want to go into too much depth here, but if you look in depth into this tool and what the market is expecting, then you expect hawkish behavior from the Fed. That's what market participants see. So the market participants expect the Fed to hike into probably a slowing economy. I'm not that guy saying something like one non-farm payroll release is capable of telling you where the US economy is headed. But when we look here, this is Trading Economics, another tool which is completely for free, and I highly recommend checking out. You can check hundreds of indicators, fundamental numbers from US, but also for example, from Hungary or from Estonia, and so on and so forth. So everything is available here completely for free. In our case, we're looking at the US employment situation. And now let's have a look here at the GDP growth rate and the latest numbers, which were released, as you probably have witnessed, last week. That was on, let me just see, I think it was Thursday last week. Minus 1.4%, was expected to come in here at 1.1%. So we're in a recession right now. So for the first quarter, first release, the data release here was negative economic growth. This is recessive. So this is like the US economy is shrinking. So you see a shrinking economy, you see a mixed employment situation, and you see market participants expecting to fight to combat inflation in the US, to aggressively hike rates. So this is an environment which is overall not very positive for equities, which is probably the main reason why we currently get to see here this bearishness in equity. So in this is the DAX, but also we can have a look here at the NASDAQ, but also we can have a look here at the S&P 500. Simple, same picture. So all in all, this is not a very positive environment in which we find ourselves. And obviously, after yesterday, we can also see that this hasn't been fully priced into the markets. So long thing short, this is not very favorable, and bulls really have to show that they're still there and not that they are not in the weekend already. Why do I say that? Well, when looking here at this region, you can see that currently, in case of the S&P 500, we are trading in a region which is nearly around the March, respectively, the February lows here, which we are testing. We saw an overshoot here that was on the 2nd of May. That was at the beginning of the trading week. Let's just go down here to a 50-minute chart, and so let's have a look here. So we flushed lower, let's say. So that was on Monday, and then we saw this sharp reversal and closing above this breakout region. So there was no follow through on the downside, and this flush out moment. And in addition here to the Fed, let me come to the conclusion that we are probably out of the woods, at least short term on the downside. And that was one of the reasons why I was very, very positive. Still, there was one important resistance on the upside, which market had to clear. In this case here, breaking above 4,300. So this last relative high here in this context. But yesterday in the morning, especially when European markets came in, and at least the DAX was capable, European markets, and in this case the DAX then was capable of holding this breakout region, was like, well, this is like bulls will find or try a second time here after the initial attack on Wednesday into the evening, and then the next break will be successful, and the close above will probably bring us up to 4.4, 4.5 somewhere here, and it was completely wrong. So that was just a feeling. I didn't trade it. I didn't trade it on the long side. I didn't trade it on the short side. So I wanted to wait for the confirmation. And when I checked the charts yesterday, respectively the quotes, I was like, okay, this is not looking promising anymore, especially after this sharp drop. And now it's not just that we saw a sharp drop, but the market is currently consolidating here around the lows, and in this case around an area I consider to be quite significant, around, let's say, 4,100, 4,110 points. So if we look here, where we're trading, and these are the lows here from yesterday around this area, then let me just put it that way. One sec. This is now a scenario for the short side, which we should be really careful about. So there's two potential outcomes. One is we're now holding the region here, and bulls are coming in and push us significantly higher, above 4,000, I say 170 or something like that. So mixed job reports, hawkish Fed, but still nearly fully priced in, and bulls are taking over after the market was now caught on the wrong side, on the upside wrong side, and then on the downside on the wrong side. I saw also a chart in the morning. Unfortunately, I haven't found it anymore. That the moves we saw yesterday from a statistical standpoint were extraordinary in terms of like 3% up and 3% down moves. This doesn't happen that often, and that you get to see one on the up and one on the downside in 2 days in a row is has a probability of nearly zero. And having these two very extreme events now is now putting market participants to the test, let's say, and especially given the overall bearish environment and sentiment we find ourselves in, I would say, well, probably it's a little too bearish. Market participants are probably preparing for a break lower, which is then giving us a chance to see a squeeze higher, which could probably see an acceleration, let's say, if we push above 4,170. And if we can hold this region, let's probably make it round. It's like 4,200. But But if I'm wrong here again, and we don't get to see the squeeze higher, and we are dropping and holding below the lows from yesterday, which is around 4,100, probably a little higher, 4,110. If we get to see this, then I definitely want to be short. I definitely want to be short, because then I could expect, or I expect really, to see a test of the psychological relevant region around 4,000 points, probably even a push lower. And this is something you can also understand now, where these, let me just go back to the daily chart, where these pink lines come from. So like this is like a equals C projection, we can call this. So you can have the all-time, or you have the all-time highs here, and then I go to the March lows, I'm sorry, February lows, and I duplicate this level here, and then I project here from the highs we've seen at the end of March, around 4,600. I project it, and as you can see here, we're coming out around somewhere between 3,900 to 4,000 points. And I think this is very likely that we get to see a test of this region if we drop 4,100 today and if we hold below. So this is what I'm preparing for. I've already prepared for. And by the way, something which is very similar to what we've seen. Let me just see. Oh no, this is December, probably a little way far away. Let's just go back to the daily chart and zoom a little in. We've seen a very similar day, Thursday, closing price on Thursday, 2 weeks ago. So you probably remember we saw an attempt here to make it back above the SMA 200, the SMA 200 in this case, and we failed, and not just failed, but we closed at the lows, and we saw elevated volume that day. And when we came in, we saw this candle here that was on the 21st, 21st of April. I came in very bearish already in the morning, and I said, well, if we now drop, it was around, let me just see, 4,000, 4,003, 4,380, 4,360. I'm not really sure. I'm usually I look at the SPY in this case, so the ETF on the S&P 500, but somewhere in there, when we dropped this level and didn't make it back above, and we also held below the volume weighted average price, that was, in my opinion, was a clear sign. It was around 1 hour into the day, probably 1.5 hours. I'm not really sure which time it was, but it didn't happen in the first hour of trading. So the market now needs to find a fair price. Probably we get to see the drop. We already can see here, so pushing lower, coming in bearish into the day. And if we now break and hold below, and we hold below German time 4 p.m., so London time 3 p.m., this is then a reason to be, I think, very bearish into the weekly close. And I really expect this then to be the bearish driver also for the next week to come. And chances are high, I think, that we are getting to see a test of 4,000, probably 3,950 in the next week to come, which is then, by the way, we close the cycle now, coming to the DAX here, which is also a reason to be very bearish on the DAX in this case. And I could imagine that we are not just going for a test here of around 13,550, but I could imagine that we're also heading lower, probably going for 13,000 in the weeks to come, not just in the weeks to come. But with this bearishness, I think this should also weigh more and heavier on the DAX then in this case, given that it's not just a hawkish Fed in this case, or a hawkish ECB, which is not hawkish at all, but it's especially the pressure we see on equities most recently, given the tensions between Russia and in this case the EU in this case, and the war in the Ukraine. So given that, and especially with Germany playing some kind of key role here, I could imagine this to be another very bearish driver, which is not really inviting us for the long side. But this is a little longer time frame. So first of all, and right now into the weekly close, we should focus on the S&P 500. We should focus on the region around 4,100. And NFPs didn't serve us well. So mixed report in the overall environment. as expected, as I already pointed out, as you can see here. So nothing really spectacular on the upside, which means like market participants are probably fearing even more now that we're headed into a stagflation in the US, into which the Fed has to hike rates, which is not very positive for equities. And if we now drop a very important technical level, 4,100, then it could get really, really ugly. And then we're probably headed for a minimum 100 points lower from here. So that's it on the S&P 500. Let's have a look at the macro picture. Let's have a look here at the euro, respectively at GBP USD. I've already seen that there was a question. Yes. I think Darshan, this is one 100% right, and I wasn't really surprised to see the rally into the Fed. To be honest, I wasn't even I wasn't really that surprised, even though the heaviness was astounding. That was the last Fed meeting. It was mid-March when we saw this heavy rally here in the Qs, but also in the S&P 500. Up to and also above the SMA 200 in this case. Most of this bearishness was already priced in. So market participants really expected the Fed to come out as it came out then. So this is a classic environment. We usually refer to buy the rumors, sell the news, respectively this way, the other way around, sell the rumors and buy the news in this case. But what we certainly get to see here is the very clear reaction after the day of the Fed, because this is what you expected. And this probably also the reaction, the very bullish reaction, caught many market participants on the wrong side. And if they're not yet out of the market, they are probably getting squeezed out today if we're dropping 4,100, because this is the region here where we know that bullish is not the option right now. Long is not an option, but we should be really, really careful with with long engagements. In fact, should favor the short side. In case of EURUSD, what we've also seen, and this is also an environment in which we find ourselves right now, stagflationary environment, Fed hiking rates, more aggressive than its global counterparts like the ECB. This is usually an environment in which the US dollar performs also quite well, at least short term. I say short term or midterm because it now depends heavily on how far will the Fed let the market correct and to some extent crash, in fact, until she says, okay, enough is enough. We fought inflation, but now we have to stabilize equity markets again and make sure that market participants understand that they can still rely on us and that the Fed put is still there. So we keep markets, let's say, at an elevated level, respectively stabilize them once it's necessary. This is usually then an environment in which the US dollar doesn't perform that well anymore because it means more dovishness from the Fed. But right now, and as you've seen over the last weeks, US dollar has performed really well, preparing already beforehand to some extent market participants for higher volatility. And let's come here probably to a chart which is quite interesting in this context. I prepared this. This is a website. It's a bar chart. And bar chart usually is a very good source when you also want to get an overview of where our bigger market participants are positioned, how they are positioned, like commercials, non-commercials, big speculators. In this case, so I'm usually looking here at this chart. This is even more in depth. As you can see here, you have not just non-commercials, commercials, but you also have asset managers, institutional traders, leverage funds, and so on and so forth. We only want to focus here. And as you can see, most recently against 90 around, these large specs bet quite aggressively on the US dollar to gain, as we have seen here. And this is a chart going back till 2003. So these are the highest levels we currently witnessing here in the US dollar index future since minimum March, February, COVID-19 pandemic hitting 2020, respectively before that in December, January 2016, 17. And what's certainly very interesting is now the question is, are we about to break out here on the upside, or will we see a drop first and then taking off and breaking higher. To be honest, I think it will be the second scenario. I don't think we will get a straight follow through here on the upside. But however you put this, I think here we are headed lower in EURUSD. Also after today, so the most optimistic outcome I formulated in the morning, it was like non-farm payrolls come in weaker than expected, and this probably giving the US dollar some kind of headwinds, and probably we get to see a bounce here from this lower trend channel, and probably heading up to 107, probably 108 in the days to come. But also this is not happening, so the euro continues to stay very, very weak. The ECB stands with its back against the wall, so no really chance. Well, certainly they can come out and say let's hike rates. They are hiking into a highly inflationary environment, with German economy heading towards a recession. Germany was the only economy, in fact, which let's say let the euro survive in its way, and it was clear. Many skeptical people here, especially in Germany, economists. But I'm not really sure whether it was only focused on Germany, or we should only focus on Germany. I could imagine that many European economists also had a similar view. They were saying, well, once Germany drifts into a recession, for whatever reason, doesn't really matter if it's COVID related, if it's like a Ukraine war, or whatever is the reason, whatever is the trigger, if Germany is heading towards a recession, the euro is doomed, because that was the only reason keeping the euro alive. So given the current environment, and given also the massive monetary stimulus we've seen. And now, well, Germany is done. So, I mean, I'm located in Germany, and what I can say is, whatever you hear in terms of positive research or positive notes or positive news, well, this is fake. So this is like, here's nothing. There's no beauty in this anymore. There's nothing in Germany. So like, if you want to do business, you don't come to Germany. That's just what it is. It's a very, very business unfriendly environment. Has always been. And will probably be even more in the future. And now, with especially producer prices rising to heights never seen since the 1950s, I think. There's no real way to get Germany out of this hole in this context, which means like the ECB has to fight inflation, hiking rates. Well, the ECB can hike rates, because if she hikes rates, well, then the European southern periphery around Italy, Spain, Portugal, and so on and so forth will just collapse on the debt they accumulated over the last years. That being said, delivers a very, very dark outlook for the euro as a currency in general. And that being said, means that any push higher will aggressively be sold, in my personal opinion, at least, here, against the lower trend channel. And if at all, we will probably head up to 108, but probably we will head lower. So most likely we'll see some kind of consolidation sideways. So if you want to trade the euro in such an environment, or if you're thinking that the US dollar is headed for a corrective move, you don't want to trade the euro against the US dollar here, because the euro is relatively weak. That's all. So you don't want to go with the weakest currency in this environment, but you want to go with a currency which is probably. Oh, I haven't prepared it, by the way. That's unfortunate. Let me just head over here. So you usually want to go with a currency like GBP USD, probably, which is well, even though right now not the most attractive currency, but still, this is now GBP USD on a daily chart. But still, I think longer term chances are higher. That pound sterling will come out stronger out of this current situation, especially economy wise, and after the Brexit. because I could imagine that many small to mid-sized businesses will go for a country which is let's say not that complicated in terms of it will be more attractive for capital, which is trying to build something. Let's put it that way. And still, yesterday we saw a very, very bad environment. Not just that the USD currently is very strong, but also, oh, let me just check out here. Okay, now we are obviously breaking lower. So we already broke 410 in the SPICE. So that's not very good. First 15 minutes of trading. Let's see whether this is a sustainable move. If we now see a bounce, but we can make it back with 410, I think then the bearish scenario is definitely playing out. But let's come back here to GBP USD. So yesterday we saw the Bank of England hiking rates also into a stagflationary environment. This is nothing you want to do. So usually you want to deliver more liquidity, but to fight inflation, they have no other choice than that. And this is the reason why a pound sterling is now selling off. And obviously the pressure is not yet done. So in the morning, I was like, okay, let's see whether we can hold above 123 in this environment, or 123.50 probably. But we haven't really. Like now we are fighting with 123. At least we are capable of holding these, let's call it flush out lows from the morning, shortly after the Asian European markets started. Let's see whether we can hold these levels. If so, well, probably then we get to see a push higher, but I want to be long GBP USD for a bounce, at least short term, only above 123.70, probably if we hold above 124 on the upside. If this is successful, well, then we're probably having a chance at least to see a pushback up to 127, since the mode overall is very extended on the downside, but the bearish momentum is diminishing. Let's put it that way. So we see that the market is making lower lows, but they are not confirmed, at least not right now here in the relative strength index anymore. We have recently had a webinar, if I'm not mistaken. I'm not really sure. Or will we have one? So I'm a little irritated because I prepared at least a presentation on that, on divergences here. So what they are and how they can be played, or at least what they indicate. And in this case, such a divergence is pointing that the market is probably about to lose, in this case, bearish momentum, and is probably headed for a bounce. So I'm not a big fan. You probably have guessed it already. I'm not a big fan of the euro, but I could imagine that pound sterling, at least short term, probably sees a sharper bounce, and especially if we can hold short term above 124. So this might be true, especially after today's job report, because this is somehow making it a little more unlikely that the Fed really will go for 75 basis points at the next June meeting. And once we start to price this out, this is probably a reason to be more skeptical of the US dollar and see a sharper push higher here. Not necessarily because pound sterling is so strong, but because the US dollar is then seeing a corrective move after its very extended move on the upside, as we pointed out here. And finally, let's have a look here at gold. And so I think, fundamentally speaking, the move the last weeks especially, and the hard push lower against the 2000 USD mark doesn't make sense. I think it's mainly driven due to the negative correlation between gold and the US dollar. And so now we are trading in a quite interesting range here. So I'm sorry, region, not range, in a region around 1,850 USD per ounce around. So if we can hold this level, if we don't push here below the lows which we marked here on Monday, Tuesday, somewhere, and we can hold above 1,850, I think risk reward wise, gold is quite attractive from the long side here. especially given that we're probably about to see a corrective move in the US dollar. And if we get to see such a move, and especially if gold is capable of pushing here back above 1,900 USD, I think a deeper run up to 950 in the weeks to come in gold seems like a serious option. Even though for a clear bullish picture, I want to see gold pushing back above 2,000. But if we push, then we're probably headed for new all-time highs. But this might take some time at least, and need some support, especially from the Fed support in terms of like we are not as restrictive or as hawkish as our market participants are expecting us right now. We can't afford this because else we face the risk of crashing the market. Probably that's a good way to put it. And that's it. Yeah, that's it from my end. So let me just probably finish here with a look at the S&P 500. So there we go. So this is the drive lower into the opening. So this is a 50-minute chart now. We are still 20 minutes into the trading day spot. So Wall Street just opened 20 minutes ago. And usually you say the first 30 to 40 minutes, we are like finding a fair price, or this is like, yeah, this is an environment in which you just have to wait. And currently, obviously, the bears are in control, the sellers are in control, pushing the market lower. But we need to see whether this is a sustainable move lower. So if this support line here around 4,100 can be held. So if we get to see some kind of snapback now and retest of 4,100, and we hold below, this is usually a bearish sign. The same is certainly true if we know hold significantly below that and then start to consolidate sideways and build a tighter range after 4 p.m. German time, so 3 p.m. UK. And if so, then I'd go or look for short engagements in direction of the first initial drive. If we make it back above 4,100, well, then things are probably not as bad as they seemed yesterday when we closed respectively after the first minutes of trading right now. And then I'd be more careful on the short side. But right now it looks like as if 4,000 is the level we will test. Not necessarily today, but probably the week ahead. And so yeah, that's it. That's it from my end. Let me finish here with the presentation and here with the contact details from Admirals. So if you have any questions, please feel free to reach out to Admirals here, YouTube channel. Leave a thumb up here. Leave a comment below if you like what you're seeing. Subscribe to the YouTube channel. Excuse me. And we talk again next week, I think. So today's Friday, so most likely my next event will be next week on Wednesday, and I really look forward to it. I hope you enjoyed the webinar, and that's it from my end. Have a nice weekend. Enjoy yourself, and if you have any questions, feel free to leave them also in the chat box below. All the best. Happy trading. Bye-bye.